Let's jump right into the markets here. We got a really strong metals markets here this morning. Gold up $27.70 to 1832.30. Um, what you're looking at right now on the chart is basically the gold market with the daily numbers on the left of the chart and the weekly numbers on the right of the chart. Um, what you see here is basically the market has reverted from this extreme level um, that we have below 1800, basically, that we've been suggesting all the way down into 1789 or so to accumulate positions. Where, if you take a look at my videos for the last few weeks, basically, we've been recommending these levels to be very strong levels, and basically probabilities that the market, upon confirmation and testing of this level and reverting from here, that we can begin to see the market revert back basically to the bigger means. In fact, we've done that. We've traded above the average of 1807 on the daily. The weekly has been 1806. And when the market came through these average prices here, as you can see just a few days ago, um, and yesterday at 12:15 p.m., we traded through the 1806 level, and we recommended actually this trade to our trading room, to our subscribers in our private trading room, and you can see the market completing these targets of daily of 1825, 1818, and also the weekly sell one target of 1822, which was activated when the market traded above 1806. Now, the market trading above 1825 on the daily is basically um, the sell 2 level, the sell 2 level of the daily. So we have completed the daily program. The daily algorithm is completed. The pattern is completed. And we are trading on the weekly signal, the weekly and the annual signal. Um, the annual average is 1810. And what this has done basically is it has integrated now all of the trends, including the annual trend. By trading above the average price of 1810. On this chart here, what you see is on the left of the chart, the 1810 is the annual average price, and you can see here the market yesterday at 6 p.m. it went right through this average and activated the annual bullish price momentum, and also the monthly average of 1813 was activated. So here we pretty much aligned harmonically, almost at par or perfectly, you might say, the averages daily, weekly, monthly, and yearly, which was a pretty powerful signal that you can see here. It unfolded, and so now we're looking at pretty much the the monthly and the daily targets, excuse me, the monthly and the yearly targets. And you can see here the monthly target still into that 1876 level. The yearly target is 2150, which was published in Seeking Alpha back in September 28 of 2020 of last year. And you can also check some of my videos on my archive in my website, ema2trade.com, where we have posted these videos as well. So where do we go from here? Well, what we want to do is simply hold on to our core positions that we've been recommending. We've been trading the market short term, but we've been holding on to our core position. And so far, the VCPMI has identified what appears to be, the bottom of the market on a 61.8% Fibonacci correction that we have seen. This is the daily chart for the expiring contract, which shows us basically the bigger numbers on the monthly and the yearly numbers. And what you can see here is the market is trading above the averages annual and monthly, and it has activated the monthly target of 1876 to 1982, which is in the process of being pretty much resolved. And on the bigger picture, which is the higher fractal in price, on the yearly, you're looking at 2164. Now, because we are trading now above the averages, we look at the shorter term targets, which are the monthly targets, obviously, and these targets so far for the rest of this month are 1876 to 1982. Now, this doesn't, guarantee that, this 1982 is going to be accomplished by the end of the month. Although, anything is possible in these markets the way they are trading. So, but for the purposes of identifying the algorithm for the remainder of the month, it will be 1876 targets to 1982. Until we get the numbers as we come into next week. The annual target is 2164 that has been activated. One of the things that I pointed out in my last videos here is this flag. In fact, I highlighted it in a thick red line because I wanted to emphasize the bear flag formation within the Fibonacci trend lines that you see here within this uptrend channel that the market has established by coming down and testing the low of 1750. The previous low that I was talking about was basically the low of 1673, which was the 61.8% Fibonacci retracement. So if we take a look just at conventional technical analysis using Elliott wave, for example, of wave counts, this rally from March the 8th at 1673 is the first leg. From the low of 1673 to the high that was made at 1915 on May 24th. From here, the market came down and this was on the Chairman Powell news last month. On the rhetoric that basically that we're going to taper sometime sooner, 2022, 23. They're throwing, 2 years out, 3 years out, like it's a fishing net. And the market took it that they were changing the stance in interest rates and basically they were going to taper. And in fact, the market collapsed across the board. Metals, commodities, stock indices, everything collapsed. But if you notice, the market collapsed into this blue level that I simplify the explanation to identify the algorithm, that when the price comes down in general into the blue level, and you can see clearly these levels are, even all the way down to 1769. After testing this 1750 level, the market reverted above it and closed at 1787.50, which you can see is activating the buy triggers that confirm the reversion to the mean principle as possible. The signal was activated, and when the signal is activated, automatically you can use the low that was made on this bar, in this case was 1750, and automatically your targets became 1806, 1807, in that vicinity. The market rallied to a high of 1835 on July the 12th, and it entered into the red zone now, which the AI identifies it to be an area of distribution of supply. This is where you can expect to see supply come into the market. If the demand factor is less than the supply, this is what happens. The market reverts and comes down after that high of 1835 and made a law of 1789. And you can see here now the market is breaking out of this little flag that I'm identifying for you guys, which is considered a bearish flag, and in conventional wisdom, technical analysis, basically it's a bullish formation upon the market breaking out. We broke out of this flag on the 28th yesterday by closing at 1811. Again, 1810 is the yearly, so it closed above the yearly, it closed above the daily, it closed above the weekly, and when it traded through 1813, it closed above the monthly, locked in all of the trends harmonically. And this is the reaction that you see of the energy being resolved harmonically. Now, I'm using a combination of different indicators obviously overlapping, I should say, the VCPMI, because it gives me a sense of confirmation more than anything else. And in here, you can see the market breaking through this Fibonacci trend line resistance here, breaking through it. The next target is the 1846 level, basically, that coincides with the weekly target of 1845. So this validates and confirms my target of 1845 is in a very good level, high probability area that the market is going to accomplish that target. And then we let the market see what it's going to do. And obviously, if we, like the daily here, traded above 1825, then the program goes neutral. The daily program goes neutral, and now we got a target basically, which is the weekly. And if we close above 1845, then we're looking at basically the bigger numbers, which is the monthly and the yearly numbers. The market begins to roll into those signals. And so the next target, closing above the sell 2 level of the weekly, would be the monthly target of 1876 to 1982. And so what you see is the trends rolling over again from the daily, the weekly, the monthly, the yearly, and eventually into the 9-year cycle, which is the big picture, which is the big trend, which is the mother trend. The silver market is on a tear, reverting from the low that was made at 24.51, ideally into this level of accumulation that was identified following the logic of the algorithm, closing above the buy one, activating the triggers. The daily targets were identified, and then obviously it activated by trading about 24.75. Also the weekly, here's where the daily integrated the weekly. And you know, when you see this combination harmonically, it's a pretty good probability that the market will revert back to its average, to its mean, which is 24.90. And when it trades above the mean, you're looking at you know, the higher levels being completed here on the daily of 25.15, 25.31 is the sell 2. Now, here is the signal from the buy one weekly level that was activated at 24.75, completing the target of the average of 25.38, and also is on the way to the sell one level that we're looking at about 25.85. Now, here's what I want to point out to you. 25.85 is also the buy one level of the annual. And so the silver market trading about 25.85 could potentially be explosive, because now, as I'm pointing out to you, it's integrating the daily, the weekly, the monthly, and potentially here we're looking at a close about 25.85, activating an annual buy trigger. Automatically, you're looking at you know, again, some targets up into the 27-28 area. And what I've been suggesting here and recommending is that the move that potentially we are looking at was going to be rather quickly. Uh, so the next window that we have is about the 5th of August, where we want to see potentially the market trading above 2630 and see how much it unfolds into that 27 target or 2750 area. I wanted to focus today on using the application of the VCPMI, as I said, as a trading tool, as a GPS, as a guide, because it's been telling us to position ourselves in these metals, regardless of the, um, you might say, fundamentals that have been pretty much skewed by the paper markets, by the um, pretty much, I would say, short side of the market that continue to have influence in the prices of precious metals. Um, I would say to you a lot less than before when they bring the market down, because as you can see, whenever they do that, it's a fantastic buy-in opportunity to add to your long-term position. And if we talk about the fundamentals here for a minute, um, I think it's pretty obvious that the path of least resistance here is to continue for our government to print money. According to Chairman Powell yesterday, obviously, uh, the message that I got, which is what I use to recommend, to add to these positions and buy any corrections into that announcement, is that basically they're not going to do anything. And the rhetoric of last meeting regarding the possibility of tapering uh, caused, a tantrum in the market, and it just kind of indicated how fragile the general market is to any comments made regarding tapering. It is my strong opinion that the government cannot afford to raise interest rates. The economy is very fragile, particularly going into this recovery, this new normal recovery that we're looking at, which still has a lot of issues that are not resolved yet. Transportation, um, the supply chain is broken and still um, seems to uh, be creating this squeeze, this bottleneck, you might say, that's causing this short-term inflationary spike that we are seeing. But I think as things normalize more, if we do not go into another lockdown, which is right now at risk, still, um, um, then I think we can begin to see a normalization of supplies coming into the market and relieving some of these high prices that we're looking at. With regards to the purchases of the Treasury, uh, it looks like they are going to continue to buy about $80 billion worth of government bonds. and I believe it's about $40 billion of mortgage securities, which I'm a little bit confused as to why they should be buying mortgage securities when the market is roaring. As you can see, retail prices here are at historic levels. One of the things that I'm recommending my traders here in Discord and my subscribers is basically that the metals markets will react in its own time. And I believe the time has come. I said that a few weeks ago. I published basically on my YouTube profile some videos that I believe were pretty risky and recommending buy silver, buy gold, buy Bitcoin at the market. This was last week. And fortunately, the VCPMI has been very accurate once again. If you go to my latest from Patrick MontesDeOca on YouTube, you're going to be able to see these reports that we published regarding the signals, the trigger points, the special alerts to buy gold at the market. This was 1 week ago. To buy silver. And also to buy the GBTC Grayscale Bitcoin Investment Trust, which is the instrument that we're using in digital assets. So please feel free to go to my YouTube account and see the videos that we post. You'll be able to appreciate, hopefully, and get some insight prospectively in terms of what to expect in this market. So the markets now are beginning to react to the fundamentals that do not seem to bode well for the economy. Some of the stimulus that was supporting unemployment, that was supporting foreclosures is going to be eliminated as of September, and there is a high expectancy of foreclosures unfolding here as we move into the end of the year. So the real estate market is in question. Some of the bubbles, you might say, that have been created as a consequence of this pandemic, of this basically incredible amount of stimulus that has come into the market by our federal government. The market is flooded with money. The balance sheets of the feds are over $8 trillion. Savings are at a record level, and people, homeowners, are benefiting from this incredible appreciation in real estate, which was completely unexpected. So, how does that translate basically to an economic recovery? And whether that demand, you might say, or potential velocity of money that could come into the system could ignite to be highly inflationary. My opinion is that what we saw after Chairman Powell announcement last meeting, not yesterday, but the previous one, was a way to manipulate the bubbles that we were seeing in commodities. They were able to succeed that. The markets corrected and have come down now, adjusting to the real fundamentals, which essentially call for much, much higher prices to come, which is basically inflation, I think, is going to be here for a little while. And if, according to the 10-year note, it's indicating that there's nothing really to be concerned. Um, we could be running into an acceleration, you might say, of prices until we can resolve the supply issue. The sooner the better. We have a shortage of supplies across the board, from computer chips to plastic bags to uh, commodities, metals. So I think the metals markets obviously got the green light that they're not going to taper, they're not going to raise rates. They, I believe, emphasize that, and so all of that basically is very bullish for commodities, very bearish for the dollar. As you can see, the dollar is down about 28 points this morning. $91.96. So continue to hold your derivatives long and continue to allow for the market to give us back the equity. And ideally, again, if we do close above 1830, 1835 here, then we're accelerating potentially to move into the $1,900 level into next week. In the meantime, my friends, once again, thank you so much for the opportunity to share this with you, and I do hope sincerely this has been able to help you identify the best and most highly probable trading opportunities in this market. You take care. I'll talk to you soon. Have a great trading day.